Welcome to A Course to Retirement with Grand Rapids Certified Financial Planner Ron Courser. Ron Courser and Associates are planning today for the potential of tomorrow.
And welcome into the program. This is your Course to Retirement. Grand Rapids, your resource for that common sense approach to planning for our financial investment and retirement future that we all need, navigating this crazy, confusing, complex financial world, is Certified Financial Planner, CFP resource for Grand Rapids area savers and investors, helping us chart our course to retirement. Ron Courser here with us. Ron, welcome in.
Well, good morning, everybody. Good morning, Peter. And to those of you listening to today's program, I want to wish you a happy and blessed Easter weekend. And also, I know that some folks at church have said, well, Ron, we listened to your program for the first 15 minutes going into church. So for those of you who want to hear the whole program, you can just go to our website, www.roncourser.com, and click on the blog, and you can tune into as much of this program and also previous programs for, as they say, for your listening enjoyment. So I want to welcome everybody in today's program. We're going to touch on something that it's kind of like when your mom used to say, eat it, it's good for you. And that's called taxes. Yeah. Let's talk about it because it's good for you. So we're going to go through that today in today's program, talking a little bit about taxes.
Ron, I'm picking up on a theme here. A couple weeks ago, we talked about the broccoli of the financial world. You must have had some likes and dislikes in your diet growing up.
It is. And I still haven't recovered emotionally from those yellow wax beans that my mom used to make me eat from the Del Monte can. I'm still a victim on that one. I got to get into some serious therapy and maybe work through all of that stuff. But we're going to talk about taxes today. Why would we do it when tax season is almost gone? Well, it's never too late to learn a little bit about taxes. There's a lot of folks listening to today's program who have already done their taxes, but there's some people that may have a couple things left they need to do. But you know, whatever we've done with taxes in 2020 is a done deal. We can't go back and make changes. We can make some adjustments, say if you want to put a 2020 deposit on a Roth contribution and things like that, but there's not much we can do. So why would I want to talk about taxes here? It's simply because to give people some ideas of what they might look forward to thinking about in this tax year of 2021. Taxes are upon us, and we've said a lot in this program that one of the biggest expenses we will have in retirement is paying the tax man, just paying taxes. And so if we can legally, ethically, and morally deal with this issue and do it above board, nobody's required to pay more in tax than they have to legally. And so our job here is to really talk about taxes. How do we keep them to a bare minimum? I tell folks there's no good points. You don't get a gold star for paying a lot in taxes. You probably get a gold star for paying the least amount legally in tax. But if you want to make contributions or help people in need, do it on your own, not through the tax system. Just contribute or help people that you see needing something. You'll be blessed by that. And it's probably more effective than asking the government or the tax people to funnel money into a problem. If you see a problem and you can do something about it today, do it. Don't wait.
Yeah.
Don't wait.
Yeah, the ultra mega wealthy, Ron, have told us for a time or two that the wealthy people need to pay more in tax, and yet they have whole accounting teams and departments and CPA firms to help them reduce and control their tax bill. And so I think, it's obviously something that we need to take the merits of taxes and the fact that obviously when we pay tax, it's kind of the government deciding what is best with our money. And I think most of us would agree that we can decide how best to use it. We do get benefits from paying taxes, but we need to use as much as possible our own discretion. I think we all feel we have better control over it. And Ron, you made another point here that it's a good problem to have. Well, it's still a problem. And yes, tax season is almost over, but I think with something like this, and in fact, many of the topics that we talk about in the financial world, is that you have to reach people when they're thinking about it, when it's important to them, in order to have it be received. If we talked about tax planning in the 4th of July holiday week, it might not be something that people really want to pay attention to at that time. But now that it's right upon the tax deadline, probably half of our listening audience has already filed, and that's okay. But maybe half has not. That's also okay. But now is when people are thinking about it. So now is when we need to talk about this kind of topic.
So let's talk about taxes. We all want to save as much as possible and pay as little as possible. That's really a good idea. But then there's some ideas that sometimes sound a little goofy, but they really aren't. Maybe if we pay a little more now, depending on the strategy we're going to use, we can pay less going forward. What about tax rates? Do we think as we hit in a wonderful thing called retirement, well, do we anticipate taxes coming down? Tax rates coming down, things like that. If we want to have an increase in our life savings, we want our money to grow, does that mean our tax bill also has to grow? So we're going to talk about strategies today, some ideas to think about, and some key things you need to understand about taxes that'll help you make better decisions going forward. Again, we can't do much about 2020, but we can certainly do a lot about 2021, 2022, and so forth. So where are we going to start? One of the key things that I always encourage folks, and we talk about it when we do reviews with our clients, we talk about taxes, is to understand some basic things about the tax system itself. Now you can, a lot of people do their own taxes with software, or they pay somebody to do it. But a couple of key ideas about our taxes. Number one, it's supposedly a progressive tax system. What that means is that people who make the least amount should pay the least amount in tax. Now, we know that that's not always accurate because there's some really big corporations and some really wealthy people who use the tax code legally to avoid paying tax. And sometimes that upsets folks, but my response always is, if that's upsetting, then we ought to talk to somebody about changing the tax code. Everybody has a right to use every rule, regulation in the tax code to minimize what they pay in tax. So understanding that means that you have to understand some other things. So number one, here's a question. Do you know where you fall, so to speak, where you line up in the tax code? So if we think about tax brackets, which focus a lot on our attention. For example, the 12% tax bracket goes to $80,250. Well, do you know where you stand personally in all these brackets? We tend to focus on brackets, but one of my key issues that I tell people, brackets are important, and we'll touch upon why they are important shortly. But the real key issue is, what's your real tax rate? That's the most important tax number you can know, because that's a combination of ingredients. Your real tax rate is what you end up paying in tax, and that line that says this is your tax, divided by adjusted gross income. That tells you what you really pay in tax. It doesn't have anything to directly do with brackets. So for example, if somebody's has a real tax rate of 15%, that would be, say, 12 or 10% so much for the federal, 4.25% for the state of Michigan, maybe a little bit for the city. Your tax rate is 15% in this example. That simply means that every dollar you earn, 15% of that is going to go somewhere else. You're not going to get that. Why is that number important? Because it's different from the brackets. So let's say you decide you want to take money out of your IRA. That money's never been taxed. So how much is it going to cost you, so to speak, to take it out? If you know your real tax rate, and in this example I'm using is 15%, that just says for every dollar I take out of my IRA or 401k, I'm only going to keep 85 cents. I got to give 15 cents away to the government. So if you need $10,000 out of your IRA, you need a $10,000 bill, so to speak, you're going to have to take more out of your IRA, somewhere around 12,000 or so, uh, to, to get you what you need. That's why it's important to understand that. It's probably, from my point of view, this is just my opinion. I think knowing your real tax rate is as, if not a little more important than knowing about the brackets.
And Ron, somebody can be in a rather high tax bracket. Maybe their last dollar lands in the 24% tax bracket. That does not mean they're paying a 24% tax rate on all of their money, because the first so much is taxed at 10%, and the next bit is taxed at 12%, and the next bit is taxed at 22%, and so on. And so their effective tax rate on all of their income is probably substantially lower than the final bracket that the last dollar they earned falls in. And I think that's important to know.
Yeah, it's a blended number, and people need to know that number. And for those of you who have somebody do their taxes, ask the tax person, the preparer, to tell you what your real tax rate is. If you're doing it on your own, your real tax rate is determined by using the federal tax first. What's the amount of tax you have to pay? That number is divided by your adjusted gross income. So if you're paying $10,000 in federal tax and your adjusted gross income is $100,000, your effective tax rate is 10%. Then you add the state, then you might add the local to build what your real tax rate is. And that's the number you need to know. It's more important than anything else. Now, one of the things that I hear a lot of times when it comes to investing, particularly in investing in taxable accounts, brokerage accounts, things like that, the market's had a pretty good run up. Yeah, we had a little correction here recently, but the market's had a pretty good run up since the COVID thing hit in March of 2020. So there's some people have enjoyed a lot of gains. And when it comes to taking money out, sometimes they'll say, wow, I can't take money out of this account. That means I have to sell something that had a big gain and the taxes are going to kill me. I understand that kind of thinking, but let me add this question to the thinking. Why are you investing? You're investing hopefully to make a profit. How do you get a profit from your investable assets? You hopefully buy low and sell high. You want to make a profit. When's the best time to take profits? You're going to love this answer. It's when you have a profit. It's like, when is the best time to leave the casino? When you have more money than you walked in with. That's the best time to leave the casino, when you've had a gain. So when's the best time to take a profit on your investments? When you've had a gain. And yet intuitively, and it's part of the human condition, we don't want to take a profit because that's going to create a tax bill, and nobody likes to pay more in tax. So we have a tendency to want to make investment decisions based on taxes, which is important. But we tend to say, well, I don't want to take it out. The taxes are going to kill me. Or maybe the tax person has said, no, you can't sell that investment because you've had such a big gain, the taxes are going to kill you. Well, here's how I respond to that. Then why are you investing? Why are you investing? It's a really key decision, isn't it?
It is.
If you're not investing to make money, keep it in a 3-pound coffee can, because it's always going to be there. If you're investing to make money, if you make money, it's always better to pay tax on a gain than have a tax write-off on an investment loss. So don't be afraid to take profits, so to speak, to take some money off the table. It's not a bad idea. Yes, you're going to pay some tax on it, but you're going to pay tax on a gain. You're going to have more money. So give that some thought.
Well, again, if you need help with any of these considerations or figuring out what those best financial moves will be to help you achieve and accomplish your goals, Ron Courser is a certified financial planner and offers his services. He will help construct and design a plan first and foremost, and then help to make proactive recommendations to help you accomplish the goals that are defined in that course to retirement plan. If you'd like to get that process started, if you'd like to get your course to retirement, the plan document in your hands, pick up the phone and give a call, 616-301-2581, 616-301-2581. Ron, there seems to be this prevailing attitude that the wealthy need to pay more in tax. Kind of the secret there is that most of the middle class, certainly the upper middle class, is probably in that wealthy category. But those that are making a reasonable income probably already understand that we've got a progressive tax system, this system that we just described and went through, where each threshold, each bracket pays a higher percentage. The wealthy, those earning more money to a point, already are paying more in taxes. And it's not just a proportional amount from $10,000 to $100,000. You don't pay the same percentage. Those earning more pay a higher percentage up until a certain point, and then it sort of flattens out thereafter. I think that the key is figuring out how to classify your income and your savings so as to be as efficient and effective with it as possible.
It really is. And it requires us to make a projection of future tax rates, of future taxes, and how we're going to position our life savings to take advantage of it. One of the things I kind of chuckle about is when I hear politicians, and I'm going to say something I guess is political, so forgive me, those of you who are listening to today's program. I don't think I'm an evil person, but I'm just going to say this. The idea that we can tax the rich and solve all of our problems in our country is not accurate. If we think about the rich, those evil 1%ers that we hear so many politicians talk about, forget about taxing their money. Let's just take their money. Let's take all the money from Bill Gates. Let's take all the money from, the Amazon guy, all the professional athletes, all of these people. Let's take all their money. If we just take all of their income for this year, we don't have enough money coming in to run our government for 1 year. So the idea that we can tax the rich to solve all of these financial problems we have in this country, it's not really accurate, ladies and gentlemen. Always remember the 11th commandment. What is that? The 11th commandment says, "Thou shalt not let thyself be buffaloed." So how do you know if you're among the wealthy that are going to pay tax? Like, really easy. The answer is, do you have money? If you have money and you have income, it's probably going to be taxed. So let's think about how this tax situation works itself through our system. I'm going to do some hand shadows now in the radio program. Okay. So I want everybody to kind of look at the wall. Don't do that if you're driving. Please don't do that. But here's a couple things to consider. Think about money in terms of how they're taxed. There's 3 buckets. There's a taxable account. What is that? That could be CD money at the bank, anything that kicks off interest and dividends, say in a brokerage account, a mutual fund account that's not an IRA or 401k kind of thing. There's a taxable account. There's a tax deferred account, which is IRA money, 401k, 403b. That money has never been taxed. And then there's the tax-free account. Those are the only 3 kinds of buckets you can put money in. Because even if you put it in a tax-free account and you want to say that that's the 3-pound coffee can that I'm going to bury my money in the backyard of, yeah, you go back and get it. It's going to be there as long as you don't kind of have a memory loss and forget where you buried it. Then it's a total loss. So you have those 3 buckets: taxable, tax deferred, and tax-free. The sooner you can work with an advisor, and we do this, and I want to encourage everybody, if they're interested in some investment tax planning and trying to position their assets now for the future to minimize the amount of tax, give us a call at our office, 616-301-2581, 616-301-2581. Be more than happy to help you through this. I'm not a CPA, but I do understand taxes, and we can help do some tax planning here. So you have the taxable, the tax deferred, and the tax-free accounts. Now, those are the 3 buckets. So underneath those buckets, you have 3 classifications of income: active, investment, and passive. Those kinds of dollars are taxed differently. So it really gets down to where you earn money, where you keep money, will determine how your money's taxed, how much you pay in tax, and how many times over and over you'll pay tax on maybe the same dollar. So if you understand those things, particularly if you have time before you're going to retire, I ask people when they come in for reviews and also for the first time we meet, I say, where do you think taxes are going to go 5 years from now or 10 years from now? Do you think they'll be about what you're paying now? Because we're talking about what you're paying. Do you think you'll pay less? Do you think going forward you might pay more? Most people answer more.
Yeah.
So
Yeah.
then my response is, okay, if we're going to pay more, even if you're retired now, let's say it's 60 or 65 and you're retired, you may live another 35 years, whether you want to or not. So if you're 40, you may have 35 more years. If you're 65, you have time. You have time going forward. And if you think what you pay in tax in the future is going to go up, it's never the wrong time to figure out how are we going to minimize taxes over the long haul. What that may have you do, though, is pay a little more tax today to avoid paying a lot more tax tomorrow. That's where tax planning comes in. That's where trying to figure out where am I going to put my life savings, in the taxable bucket, the tax deferred bucket, or the tax-free bucket. And once you figure out where you're going to position those dollars in those three buckets, then you can try to figure out what kind of things am I going to invest those dollars with. Not only gives me the best opportunity to have growth, because why are you investing? You want some growth. But the real key you're investing is ultimately to create income in retirement so you can retire. It requires some growth. It requires some tax planning. There's a little bit that goes into it. So if some of this is making some sense out there for you listening to today's program, give us a call, 616-301-2581, 616-301-2581. We can help have a really great discussion about how you're positioned today in terms of the tax rules, how you want to be positioned tomorrow in terms of what we think is going to happen to future tax rates and just the taxable issues of all of our income. So we can help you do that, because where you keep your money will have a lot to do with how much you're going to pay in tax in the future, how much you're going to pay in tax way down the road. And ultimately in retirement, please understand, I don't say this to scare people, but what we pay in taxes is either going to be the number one or number two most expensive thing we have to deal with in retirement, the other one being healthcare. So give us a call at 616-301-2581, 616-301-2581. We'll have a tax discussion that won't be like me having to eat yellow wax beans out of that Del Monte can. I promise you, it'll be a little easier than that.
Ron, if you don't mind, can I paraphrase and maybe put this to an example and see if this is what you're pointing at here? If I am currently married and my wife and I are making a reasonable income, let's call it household income of $150,000, that means that my income lands me in the 22% tax bracket. However, both my wife and I are pretty frugal, and we are actually living off of only about half of what we're making, less than half of what we're making, and we are saving a good deal of our income. By looking at where we are today and then projecting out that we may in fact only require substantially less income in the future, we could maybe make some decisions about whether it makes sense to defer taxes now or go ahead and pay taxes now. And then if we maybe change things down the road, we can always adjust. But by understanding where we are, understanding how these brackets work, and then understanding what that projection looks like to track us forward, we can make better, more informed and well thought through decisions on whether or not it makes sense to defer and delay paying taxes or pay more upfront and then be done with them for retirement.
Yeah, it's a good point. It does make some sense. And here's where it starts. It goes back to that 3-bucket issue. The first step is to find out where your money is, where it is in those 3 buckets: taxable, tax deferred, tax free. Find out where that is, and then make a decision. well, if I'm going to retire in 10 years or 5 years, or if I'm already retired and I think I'm going to live another 30 years, what buckets do I want to fill up? Because then you can sit back and say, okay, what is it we need to do today to create a strategy, so to speak, an investment strategy, an income strategy based on where taxes are today and tomorrow, and figure out the best approach to take for us. And it'll be different from everybody. It really will be. Sometimes we have a conversation with folks, and in your example, they're not living on everything that they make. They're deferring as much as they can to minimize taxes. And when we sit down and think about it and say, what if, and it goes back to your real tax rate. What if you're doing well in life and your real tax rate is 20%? It's a combination of federal, state, and local. That means every dollar you put into a 401k plan or an IRA, you save 20 cents in tax, 20%. That's substantial. But what if, when you go in the future to take money out, the government has changed some of the tax rules, and now they charge you 30% or 30 cents to take that money out. So you save 20 cents going in, takes 30 cents going out. Was that a good decision? When I position it that way, most people say, maybe not so much. So it's one of the key things to consider in doing tax planning.
Well, especially, Ron, as you stated, if our objective is growth on our money, that means it's not just the 30% we are paying on the $1 we saved. That dollar has multiplied and grown. Now we're paying a higher amount on a higher dollar value. And so all of these are components that we need to understand. And during this tax season, it's a good time to have these discussions. Ron Courser plans proactively throughout the year, all year long, for his clients on how to be as efficient as possible with their dollars, with their investments, with their retirement accounts, with their taxes. And if you would like to get a plan, a course to retirement put together for you, for your family, pick up the phone, give a call. 616-301-2581, 616-301-2581, or you can go online and visit roncourser.com, roncourser.com. Again, 616-301-2581. We do have to take a quick break, but we're going to talk specifically about some of the strategies that you could consider implementing to be more efficient when we come back here on Your Course to Retirement with Ron Courser. And welcome back into the program. This is your Course to Retirement Grand Rapids Certified Financial Planner, CFP Ron Courser, here with us, guiding us, helping us navigate our course to retirement. Your course to retirement, ladies and gentlemen, is all about that plan. And if you need to get a plan put together, or even if you already have some accounts, some investments, and just want to double check that you're doing the right things with them, pick up the phone, give Ron Courser a call, 616-301-2581, 616-301-2581. Ron, today we're talking about taxes and how we can control and be efficient and effective and minimize our tax liability and those costs and expenses. It can be expensive. In fact, tax is probably one of our largest known expenses throughout our lifetime, and certainly with the way that we're saving in retirement. I heard an interesting phrase. Somebody made the statement, when it comes to retirement, the tax code is written in pencil. And I think that's the point that you were making before the break, is that the rules can change, and we need to be aware of that and therefore be able to pivot a little bit and plan proactively along the way.
You know, it really is a good idea to always remember the tax code's written in pencil, because the Treasury Department is a giant eraser. And whenever they think they need to make changes, they automatically do it. And they don't ask our opinion, do they, very often? I mean, they've never called me up and says, Ron, you're a certified financial planner. Here's what we're thinking about doing taxes. What do you think, Ron? They've never done that. I just get little memos here over the internet saying, effective the 1st of January, here's the new tax issue. Have a nice day. So whenever you think about planning for taxes, it's easy to say, well, I don't know what they're going to be, so I'm just going to keep doing what I'm doing. My response to that is, remember we talked about, and I asked you, do you think over the next 5 or 10 years, taxes will be, what you pay will be more, less, or about the same? And you said, Peter, they're going to be more. You're going to, I said, so let's do something about that. I mean, we may make plans to do some tax strategies for you. And maybe 3 years from now, we find out they changed the rules again and we have to make an adjustment. But I think that's a whole lot better strategy than just saying, I don't know what they're going to be, therefore I'm not going to talk about it. And I'll just let my tax person deal with it. Because what we have to understand is taxes, there's nothing that says they're going to be lower in retirement. When I got in this business back in 1994, it was beat into me almost by the people trying to train me. That says, tell them to pack as much you can in their IRAs and 401ks, because when they retire, they're going to be in a lower tax bracket and they're going to pay less in tax. That may have been somewhat accurate back in the middle 90s. But boy, I think it's a really dangerous assumption to make now. It really is.
Yeah.
Taxes
have come down. I mean, since the 80s, since the 90s, taxes have come down. But planning's about looking forward, not looking back, right?
Well, what's come down or what's changed is the brackets. That's what's really changed. So, back before this current tax bill came into effect, the 12% bracket, if you will, was the 15% bracket. So all they did was change the brackets. They made some other changes. So going forward, I mean, you can assume that the brackets will be the same. I doubt that. But the issue always is, what are you really paying in tax? That's always the key issue. So if you just look at that and say, you know what, I bet I'm paying more in tax today than I did 30 years ago. I think that's true for everybody. I really do. 30 years ago, when I was working, what I paid in tax was a lot less than what I pay today. Part of that is because of increases in income, but a lot of it is just how the tax world works. So when trying to figure out what are we going to do about taxes, here's a couple things to consider. Number one, you can always maximize what you put in your tax deferred accounts. That's always a rational strategy. It always is. Number two, you can always put in as much money as you can into the Roth accounts that you have. If you have a Roth 401k, that is the ultimate account, because you can defer some or all of your employee deferrals into the Roth 401k. Yes, you'll pay a little more in tax, but man, down the road, you'll have this big bucket of money that's never been taxed. Or it has already been taxed, rather, and it's never going to be taxed again. People's concern about Roth accounts is that, they're going to change the rules. They're not going to change the rules. They're not going to come back and say, I know you already paid tax on this, we're going to tax you again on it. What they will do, I believe, it's just my opinion, is there'll come a time when they will say, effective the 1st of January, you can no longer have a Roth account. Because then remember those 3 buckets, taxable, tax deferred, tax free, they just eliminated the tax-free bucket. So now we only have 2 buckets. One is taxable and one is tax deferred, which is going to be taxable. So that's the only reason they would change it. And they'll say, well, if you have a Roth, you can keep using it. So that's why it's really important, I think, for people to work with somebody who will help them create a Roth strategy in that tax-free bucket now, sooner than later. There's a lot of other rules that apply to Roth accounts, but the key is to start the clock running today. If you don't have, ladies and gentlemen, if you don't have a Roth account and you don't know how to do it, the fastest way to do it is go to the bank, tell them you want to open a Roth account, put $100 in. That starts the timetable. That means 2021 becomes your starting date for all of some of the rules and regulations when it comes to taking money out of Roth accounts. The clock starts now, even with $100. That means you could put $100 in this year and not do anything for another 5 years, and then put more money in. Your clock is 2021. That's when it starts. So that's a good idea. The second thing is to maximize whatever you can over time. And if that's tax-free, do it. If that's tax deferred, do it, with the understanding that you're going to pay more in tax. And that gets into the situation, okay, if I have a taxable account, what am I going to invest in? A taxable account creates 1099 love letters from the IRS. That just means you're going to get a tax on dividends, interest, capital gains, anything that went on in your mutual fund accounts. I know you didn't take any money out of that account, but you got a giant tax bill last year, didn't you? Yeah, that happens. So sometimes even when you create those three buckets, taxable, tax-free, tax-deferred, you can choose certain kinds of investments in the taxable bucket that are more tax efficient than maybe a mutual fund, or maybe more tax efficient than whatever strategy you're using now. And that's where we can help. In addition to trying to create the most tax efficient overall investment strategy, we can help you trying to choose those kinds of investments that are the most tax efficient. So if you need that kind of help, or you want to talk about it, give us a call, 616-301-2581, 616-301-2581. We'd be more than happy to have the conversation with you. We can help you, and we will if you let us.
Ron, I've actually heard that investing in mutual funds in non-qualified, non-retirement accounts is one of the least tax efficient, the most tax inefficient ways to invest your money. Is there any truth to that?
There is some truth to that, absolutely, because it generates internal taxable events, dividends, capital gains, interest, those things that happen inside the mutual fund. That's why, from a tax perspective, generally, and it's a very general statement, mutual funds are less tax efficient than, say, an exchange traded fund, which can operate kind of the same way, but they have certain tax efficiencies. So it's important when somebody is creating a portfolio for you, particularly in a taxable account, you should ask your advisor, tell me about the tax efficiency of this, because you're going to pay on it. You know, the worst thing that can happen is if somebody takes a loss in a taxable account because they have mutual funds. So they had $100,000 in the account 1st of January, 31st of December, they got $97,000. The account's gone down $3,000. But because of all the other stuff that's happened in there with capital gains, taxes, all that stuff, they get a tax bill, say for $11,000. That's taxable income. Wait a minute. My mutual fund account went down $3,000 this year, but I got $11,000 tax bill.
So I lost money and I owe taxes.
Yeah, isn't that great? Only in America. Only in America. So that's why when working with an advisor and they're going to propose in a taxable account, here's a great list of mutual funds, you need to ask them about the tax efficiency. And they need to be able to give you a pretty clear answer on it. Because it's important. Remember, it's not how much you make, it's how much you keep. And taxes are a deduction from a gain, or they are a multiplier of a loss. So you need to be aware of that. We can help with that. Give us a call at 616-301-2581, 616-301-2581. Be more than happy to have a conversation with you. Creating a tax efficient investment strategy overall, which includes those three buckets, taxable, tax-free, tax-deferred, is not something you do in 20 minutes. It really isn't. It takes a little more time and a little more understanding and dig it deep into what we're trying to accomplish. But we're willing to spend that time with you, ladies and gentlemen, listening to today's program. We will spend all the time we need to create the most tax-efficient investment strategy for you that fits you, that makes sense to you, and that works for you. So give us a call at 616-301-2581, 616-301-2581, and we'll help you.
Again, Ron Courser standing by. He is a certified financial planner, experienced, qualified professional, willing to help you in your planning efforts. If you need to get a plan, or if you have a plan, you want to double check and make sure you're doing the best things, Ron will help you design that course to retirement. That is concise, consolidated language, ladies and gentlemen, simple, easy to understand steps, a timeline of action items that you can take, that you can have in your hand, that you can refer back to, of what you need to be doing to accomplish your goals, and documenting those goals as well so that you can work to turn them into reality. Pick up the phone and give a call, 616-301-2581, 616-301-2581. So Ron, if we maybe have procrastinated a little bit. I'm not naming any names, could be myself, could be anybody else. If we've procrastinated and maybe have not filed our taxes yet, are there some last minute strategies? Are there some things that we could think of maybe in the next couple weeks here to bring down that tax bill?
Yeah, there's a couple things you can do even at this late date. One of the things you can do to bring down last year, you might, if you can, think about how do we harvest some, maybe did we harvest some losses? You may have them in your taxable account, but why not do it? You might be able to make some estimated payments beforehand. That would help. But we're really getting close to the end line here. So a lot of what we're talking about is, all right, what can I do this year, 2021, that'll help? And some of the things we can do, we just went through a little bit of a correction here in the market. There may be some tax losses that can be harvested right now from taxable accounts. It might make some sense. So what does this mean? It means, okay, you sell something today to harvest a loss. You may want to buy that back and really like it. You just have to wait 31 days so it's not a wash sale. And you can still buy back that thing that you like so much and still have the loss that'll reduce some of your taxable income going forward. That's one of the things you can do. You can start to set up a plan where maybe you start to put a little more in a health savings account for this year. That's really important because healthcare costs are something that's going to continue to go up. And if you think about it, if you're still working, what are you going to do about it? What are you going to do about it? Because you're going to get to a point where one day you're going to be retired. And then you're going to be in the Medicare system, perhaps. Who knows how you're going to deal with that? So one of the things, if you're blessed enough to have a health savings account, start to fully fund that thing. I mean, don't sit back and just say, well, I can only do this or do that. That's another way to really minimize ultimately what you pay in tax. And it's a great thing to do. Another thing you can do is you can consider, well, what about going forward when it comes to this whole healthcare issue? What am I supposed to do? How am I supposed to handle it? And here's a little nugget. In our firm, we combine investment strategies called wealth care with healthcare. My wife, Nancy, does an enormous amount of work, and she's incredibly gifted and good at it with her staff of creating healthcare plans for people, both for those of you who are going to retire and not get into the Medicare system because you're not old enough, or those of you who reach that great age of 65 and you can get into Medicare. She's able to craft the best kind of healthcare plan for you, the most cost-efficient kind that will help you, because healthcare costs are either number one, two, or number two biggest expense in retirement. So, for example, let's say, Peter, you're 62 years old. You're probably going to retire at 65 if you can do it. It's never too early to give us a call and say, I want to talk about healthcare planning going forward. Now, we don't know what healthcare is going to be like in 3 years, but we know it's going to be more expensive. So in terms of planning, one of the biggest costs we're going to face in retirement is healthcare costs. So if you're 62, why wouldn't you want to think about what it's going to be like when I'm 72? And the best way to do that is to give us a call at 616-301-2581, 616-301-2581. We can help start the planning process. It's never too early to start the planning process in dealing with taxes and dealing with healthcare, two of the biggest costs you're going to have in retirement. So it helps you plan. And let's say you're going to retire before 65 for any number of reasons. You're going to have healthcare. It's going to be costly. So let us help you minimize as much as we can your medical costs. My wife, Nancy, and her staff does the healthcare part of our business, and we help clients. So give us a call at 616-301-2581.
Ron, I heard a really scary math problem recently, and I'll give you the problem, and I'll actually give you the answer as well. But the math problem was, what is 2 times 3 times 7 times 10 times 52 times 20? And the answer was 436,800. And then the question was, now what does that represent? So that is 2 people eating 3 meals a day, 7 days a week at $10 a meal, 52 weeks a year for 20 years. The cost of food over 20 years of retirement could be about $436,800. And taxes are probably a larger expense. Healthcare could potentially be a larger expense. And some of this money we're going to generate as we go in retirement. Social Security is there to provide an awful lot of that. But still, scary numbers here that we have to account for. And we have to know not only how are we going to pay for those things, but how are we going to pay the tax when we go to buy those items that are going to be essential for us?
Well, I'm grateful for one thing, that you didn't have me try to answer that math question of yours.
I'll give you the answer
Because
there.
when you were going through it, I was already starting to sweat bullets thinking, man, he just sprung this on me. This is one of those spot quizzes. I used to hate those in high school and college. When a teacher would come in and say, well, we have an unannounced quiz. And I'm thinking, oh man, I hate this. So thank you. It is, when we think about it, it seems like the law of large numbers applies to everything we do in retirement. And I want people to understand, don't be frightened about these things. All we do is talk about them and plan on them. We know we're going to spend $400,000 or $500,000 on food, particularly if we go out to eat at a restaurant, if this COVID thing ever goes away, and we can have a nice meal or two a couple times a week or a couple times a month. We know we're going to spend that money. We know that that's just part of what we do as human beings. But we also know that there's a cost. There's a cost to living in America, and that cost is taxes. That's the price we pay for living in the greatest country in the world, taxes. And those of us who've managed to save a little bit for that wonderful thing called retirement are going to be taxed. So the question becomes, how do we figure that out? And that's what we can help people do. We can help you navigate this tax thing that seems to be almost like quicksand sometimes. We don't know we're in it until it's too late, and we don't know how to get out of it. Let us help you with advanced planning on this. Give us a call at 616-301-2581. We can help you tackle some of these things in a way that they're not so, oh my goodness, kind of, oh my goodness, kind of, oh my goodness, kind of. We can make some sense of it and give you some peace of mind so that you can handle it. Now, another thing that we need to talk about, and this one is kind of interesting. It's having debt as you get close to retirement. Where does debt come from? Most of it comes from mortgages. Some of it comes from car leases. Every once in a while, we find some folks that maybe have a little difficulty with credit card bill, but primarily it's the mortgage issue. And I'm going to say something right now that I'm not talking out of school, that shouldn't come as a surprise, but going into retirement debt-free is one of the biggest gifts you can give yourself. It absolutely is. And I know sometimes people say, well, I just refinanced my mortgage and it's, 2.5%. And man, it's just really great. And my response is, I'm happy for you, but it's still debt. It's still debt. We know intuitively that if we can get into retirement with zero debt, we have a much better chance of successfully navigating retirement. Because if you have debt, you have to pay it, right? Well, what happens if you have a market correction like we just went through briefly? And all of a sudden, maybe the money you've counted on is less than what you had. So going into retirement debt-free is always a goal. A lot of people are able to achieve it. But if you have 5 or 10 years before retirement, it's a major planning objective. How do I get to be debt-free on the day I retire? Because that gives you peace of mind, and it just increases financial security tenfold. So give us a call, 616-301-2581, 616-301-2581. We can help walk through and talk through all of these things. I hope those of you who are listening to today's program get the idea that just waking up one day and saying, I'm going to retire, I hope it works out, is not the best strategy. It really is a conversation you can have with us. 616-301-2581. We can have that conversation and talk about all these things and it almost gets down to lions and tigers and bears. Oh my. But, if we talk about them, right, we can get through them. It's like when you're in a dark room and you don't know if there's monsters there. Isn't it nice to be able to flick on a light switch and find out there's no monsters?
Yeah.
Well, as a kid, I used to sweat that. But shedding a little light on it, it kind of exposes it, and it's not as bad or as serious as you think it is. So let us turn on that light switch, if I can use that analogy, and help you through retirement.
Ron, I feel like as over the course of this program, we've got to know a lot about your childhood and about your upbringing in your life. Wax beans, monsters in the closet. These were big influential items in Ron Courser's approach to how to handle money here.
I'll tell you, when I was a young kid, we used to watch on TV. They would come on at midnight, these old grade B monster movies. And I had to quit watching them because I would stay up all night thinking that there were monsters underneath the bed or Frankenstein was coming after me. And I realized that I have an overactive imagination, so I'm better off not doing it. And since everybody wants to know what my life is like, my wife, Nancy, loves to watch those horror movies. I won't have anything to do with it. I absolutely, at this stage of life, I will not do that. I'll go watch NCIS or football or cartoons or something. I will not watch horror movies or any kind of movie that stresses me out. It's just no good.
My wife to this day will not watch the Chucky movies, the ones with the little doll that comes alive.
Oh, I hate that.
Yeah.
It's like a miniature clown, and I hate clowns. I'm scared of clowns.
Every time I see it, as I'm scrolling through the possibilities, I have to point it out and ask her, is this the one we're going to watch tonight? It never is. So
give me Ron, John Wayne anytime or NCIS.
There's a lot of great stuff out there. We all can pick and choose, but here's one thing we can't pick and choose on to bring this full circle is kind of the tax situation that we end up in. That's enacted upon us. We do have some choices about how we create our tax situation into the future through the type of income that we earn, the classifications that we put on our savings, and how proactive we are in handling the tax bill that we'll have into the future. And so that it doesn't have to be a horror movie. Ron, we can turn on the lights on that one.
Well, the other thing I want to encourage people to know is that, kind of hitting the tax issue head on is really good. And I love it when somebody says, you know what, I got a tax guy. And I say, great, let us work together to help you. I'll come up with some ideas. He can vet them, say it makes sense, it doesn't make sense. But together with your tax advisor and our firm, we can really create great plans for you to minimize taxes, to give you the best opportunity to succeed going forward. So give us a call at 616-301-2581, 616-301-2581. And for those of you who've listened to the whole program, again, if there's a piece that you missed, you can just go to our website and get on it. And you can hear today's program. You can hear programs we've had in previous weeks. Pick and choose what you'd like with the different ideas that are important to you. But above all, just take advantage of us. Take advantage of us. We're here to help you. So give us a call, 616-301-2581. We'll do the very best we can to make the future a little better for you.
Always a pleasure every time we get the opportunity to speak with Ron, to visit with Ron, and he's looking forward to helping and assisting any way he can. So many different aspects to our financial life: investment management, account allocation, risk management, longevity, maximizing available sources of income, minimizing the taxes on it, providing as much protection as possible while identifying opportunities. That's all part of the Course to Retirement plan. Pick up the phone, give a call, get that easy to understand language that you can follow those steps and you can work the plan to make your goals a reality in the future. 616-301-2581. Always a pleasure speaking with Ron Courser, and he's looking forward to helping you. Give a call now. 616-301-2581. Talk to you next time on your Course to Retirement.
Thank you, Peter.
Tune in to Ron Courser's full radio program, A Course to Retirement, Sunday mornings at 9 a.m. on WOOD, and visit roncourser.com for many valuable resources, including other great episodes of Your Course to Retirement.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor.
Ed Slott's Elite IRA Advisor Group is solely an indication that the financial advisor has attended training provided by Ed Slott and Company, passed biannual examinations on material covered at conferences and in webinars, and met other membership requirements and does not constitute an endorsement of any kind. Ed Slott's Elite IRA Advisor Group members pay a fee for the educational programs that allow them to be included in the Ed Slott's Elite IRA Advisor Group. Membership does not guarantee investment success. Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Any comments regarding safe and secure investments and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes. Advisory services offered through Brookstone Capital Management, a registered investment advisor.